It's now the beginning of the summer, early June, and we're approximately 6 months into the investment year. Now, trying to think of what we were going to consider and discuss today, I thought I might be a little bit lighthearted because the fixed income markets have been very good in 2014. So what I'd like you to think about is the dog that didn't bark. Now, if you've read Sherlock Holmes, you know the situation where Sherlock is involved in a case, and the exceptional item in the case is the fact that the dog didn't bark. And Sherlock brings attention to that because it's a very important non-event. And that's how I would characterize the fixed income markets so far this year. What's critical is the non-event. And the non-event is the fact that interest rates have not risen the way the doomsayers at the beginning of the year were forecasting. And that's the event that didn't occur, and that's the dog that didn't bark. And as a consequence, interest rates in 2014 have been very beneficial for fixed income investors. We had a 10-year Treasury at the end of 2013 at approximately 3%. Currently, that same 10-year is closer to at 250, 255. I pulled up a chart for today's discussion which shows the 10-year government bond basically worldwide. And if you look in the extreme right-hand column, you're going to see negatives. And what that is those are declines in yield over the past 6 months. And without exception, every sovereign bond shown on that chart has declined in yield, which means that the market price has risen. Now, going back to January 1 of 2014, if you had told the forecasters that that would be the situation on June 4th, you would have been laughed out of the room. So again, what hasn't happened is interest rates have not risen, worldwide economies have not recovered, and the central banks are still pumping liquidity into the marketplace. Why are they doing that? They're doing that to get their economies up and running and back on their feet. We just had a first quarter GDP announcement in the US, and we had a negative number. That is not indicative of a recovering economy. And as long as our Fed and the other central banks keep on pouring liquidity into the market, interest rates will not have that precipitous increase that we were all fearful of at the beginning of the year. So again, we've had a good first half of 2014, and our expectation is that while we'll see an increase in interest rates, it will not be the precipitous increase that people were fearful of. Bonds are still an important part of your portfolio. They offer stability and they offer income. Stick with the bonds. Don't listen to the talking heads. Have a good second half of 2014. Thanks.